Welcome to the Deep Dive. Today we're looking at Broadcom Inc., that's ticker AVGO. Our mission, as always, is to get past the headlines. We want to really unpack their recent performance, their big strategic moves, some of the controversies too, and figure out what it all means for, well, for their future.
Yeah, Broadcom is a fascinating one. It's a real case study in aggressive growth, but also maybe some of the, let's say, consequences of that growth. They've really evolved their business model dramatically. It makes for a pretty insightful deep dive, I think.
It really does. So they're a global tech leader, right? Big in semiconductors, but also now huge in infrastructure software.
Yeah.
How did they actually achieve that kind of scale covering such, well, different areas?
Fundamentally, it's rooted in a really aggressive strategy of strategic acquisitions. They buy companies. And that $69 billion VMware deal was, well, transformative is probably the right word. It just massively expanded their asset base, their whole business scope.
And you really see that in the financials, don't you? The expansion is just remarkable. I mean, revenues surged from, about $6.8 billion back in fiscal 2015 to over $51.5 billion in FY 2024. That's a 25% compound annual growth rate. Pretty robust.
It's huge growth.
Yeah. And their profitability is, well, it's impressive too. Q2 fiscal 25, they had gross margins around 79%, operating margins at 65%. Plus, their Q1 net income for 2025 was up like 134% year over year. So for listeners tracking these tech giants, what does this kind of aggressive growth tell us about how they compete?
Well, it raises that key question, doesn't it? How do they keep those margins so high? And the answer seems to be their strategic shift, moving heavily into high-margin infrastructure software, pushing into custom AI chips. They're projecting a, 40 to 80% CAGR for AI revenue through 2027. It really shows a deliberate focus on maximizing profit, Even if that means sometimes their top-line revenue growth doesn't quite match some competitors, profitability seems key.
Okay, but there's usually another side to this kind of hyper-aggressive growth, isn't there? I'm thinking about the debt load.
You're absolutely right to bring that up. It's significant. Their long-term debt hit nearly $62 billion as of May 2025. And yeah, a lot of that is a direct result of buying VMware. Now, Broadcom generates a ton of free cash flow, like $6.4 billion in Q2 FY25 alone, which is strong. But naturally, a chunk of that cash flow has to go towards servicing that debt, paying the interest.
Right. So beyond the balance sheet, what about the impact on, say, their reputation?
Yeah.
Customer relationships, especially post-VMware? What are some of the main complaints or controversies we've been hearing about?
Yeah, that's where things get complicated. These strategic changes, they've definitely caused significant customer dissatisfaction and, frankly, regulatory scrutiny. We saw that major shift to subscription licenses for VMware. For many customers, that apparently meant huge price hikes.
Huge how?
Well, there are reports, of customers seeing support costs jump 450% or certain service costs going up by maybe 1,200%. Just massive increases. Add to that things like product bundling, changes to partner programs. It upset a lot of people.
And led to lawsuits.
Exactly. Big names like United Healthcare, AT&T filed suits. And you even had the European Cloud Competition Observatory calling their model legally and ethically flawed. Pretty strong words. The perception out there among some is that they're kind of financially draining customers. And look, this isn't the first time they faced scrutiny. Remember the stock options backdating thing? That settled for over $160 million years ago.
Okay. So let's pivot then to the stock itself. Performance has been incredible, right? Hit an all-time high with $280.94 just recently, July 15th.
Yeah, the stock's run has been phenomenal. But if you step back and apply, say, Benjamin Graham's value investing principles, looking at underlying assets, earnings power, trying to be conservative. Well, a conservative calculation might put Broadcom's intrinsic value somewhere around maybe $152.65.
Okay, so compared to the market price of $280.
Right. It suggests the stock is significantly overvalued at the moment. It implies that a lot of future growth, maybe even optimistic growth, is already baked into that price, which means for a value-focused investor, there might be a pretty limited margin of safety, as Graham would call it.
So pulling it all together,
Yeah.
we have this picture of a financially powerful company, right? Strong market position, big AI potential. But on the other hand, you've got this really high valuation, a massive debt load, and these ongoing customer and regulatory challenges. For you, what really stands out about their strategy and maybe where it's heading?
I think what stands out is just how clearly it illustrates the trade-offs, the tension between that super aggressive acquisition-fueled growth and everything else.
Yeah, that seems to be the core tension. Broadcom's transformation, incredibly fast, incredibly profitable, turning from the semiconductor giant into a diversified software player, is definitely come with these complex trade-offs. So the lingering question for you, the listener, might be this. What's the real long-term balance? How do you weigh that aggressive growth against maintaining sustainable customer goodwill and, well, market reputation?
Exactly. And however Broadcom performs going forward, it's definitely going to keep highlighting that critical question for the whole tech industry. It's one to watch, for sure.